If you're losing money trading, then maybe you should consider avoiding trading around these times. Stay tuned. Hey guys, warm welcome to you. Thank you so much for joining me. All right, so over my time in the market, started in 2001, there are certain times which just catch out traders again and again and again and again. And I understand why as traders we trade these times, because we see people doing very well out of them, but actually it might be your undoing. It might not be the best possible time for you to trade. So let me kind of run through them and I'll explain what I mean. So the first one is the open. Well, why the open? Traders do very well off the open, and they do. There are traders who are specialists at trading the open, and I like to trade the open, but it's a very, very unique time in the market. The market's moving quickly. You haven't got much information yet. You've got the overnight range, perhaps in the overnight trade, and maybe Europe if you're trading the US, but you haven't got that much information yet. And you kind of offset that because of the chance of making a decent move, because the open is very volatile. It's the most volatile time of the day. Very often the high or low is put in the open, sometimes both. And so as a trader, you get seduced by that volatility and go, oh, I want to get involved in that open. But actually, it's a very unique skill set. It's not something I'm not saying don't trade it when you can, but perhaps if you're losing money, it's not the time to be trading yet, because it's very, very volatile. And the thing is, we come as traders, we're all prepared, we do our prep, the bell goes, we feel like we need to make a trade. And very often we make a trade, we get stopped out very quickly. It can be an emotional time. It can trigger those emotions that we don't want. It can really kind of get you and cause you to trade on tilt. And then you're digging yourself a hole in this, that, and the other. So maybe consider saying, you know what, I'll trade the open, but not yet. I'll wait for an hour. I'll let the market mature and let me get a bit more information about what's happening in the market. I'll know then whether we're in a trend environment after an hour. I'll know if we're a range bound environment. I'll know if I'm looking for mean reversion, pullbacks, whatever it may be. And yes, it might not be as exciting, it might not be as sexy, but the open tends to kill a lot of, not kill, but tends to harm a lot of traders who are kind of getting to that level or trying to get to profitability or whatever. That sort of spinning the wheels, just getting traction. I'm not saying to avoid it completely. I'm just saying consider. Just look at your data and go, do I get sucked in at stuff at the open? Does it serve me to trade the open? And the answer might be no. In which case, just put it on pause for now. Just say, okay, I'll come back to the open. I'm just going to wait for an hour and trade that. So just consider that. Second one is the close. And not necessarily just the close, but more importantly, after a win. How many times have you traded in the day and you've made some money, you've gone, right, brilliant, I'm done for the day, and then you're kind of sitting around, maybe you look at your watch and you go, oh, there's an hour left till the close. Let me just see if there's a trade. You go back to the screen for the close, you take a trade, you get stopped out, you're like, oh, I want to get my money back. I want it back to where I was on that from the morning. I felt really good about that. Take another trade, get stopped out, now you're frustrated. You take it again, stopped out, all of a sudden you're giving back all the money, maybe even more. So just watch out for that. If you're trading, you've had a good day, just lock the day in. Go, yeah, I've had a good day. I'm done. I don't need to come back. And when you say you're not going to come back, just say this. Okay, I'm going to give myself 30 seconds to confirm that is what I'm going to do. So in other words, you say, I'm done for the day. Say, do I really mean I'm done for the day, or will I come back? Because you need to stick to your word. As traders, it's very important that we say it, we're going to do it. So if you say, actually, you know what, I will come back and trade the close, but I'll risk 25% of the daily gains. If you've made $1,000, you've missed $250, for example. So you're much more methodical and careful, or you go, you know what, no, I am actually done, I'm not going to come back. So rather than on a whim saying I'm done for the day and turning off, and in your mind you go, maybe I'll come back, just spend 30 seconds to confirm exactly what you're going to do. And that's, no, I'm going to come back and I'm going to risk X, or I'm not going to come back, or whatever it may be. But just have that confirmation in mind, because that stops you then doing something, just taking a trade on a whim, losing and doing this and giving it all back. Like, I'm prepared to give back a quarter of the gains. I'm going to come back at the close and see if there's a trading opportunity that matches my setup, plan and criteria. If there is, I'm going to trade it. I've got the risk there. If there's not, I'm not. Or you say, no, I'm done. I'll see you tomorrow morning market. So as long as you've got the clarity there. Third one is Fed day, OPEX, options, expiry, triple witching, that kind of stuff, quadruple witching. It can seem, non-farm payrolls day, it can seem attractive to trade these days, right? Because very often it gets big swings and often get big reversals, a lot of meat to grab onto. But often these swings are caused by lack of liquidity getting sucked out from the order book, the market moving very, very aggressively, very, very easily. And so the patterns are sometimes a little bit different to what you normally expect. Now, I've got some specific patterns that I will implement during this time, but I think most traders, I'm not saying most traders who are perhaps less experienced in the market, that's not necessarily in a negative way, but get sucked into the volatility of these news events. And again, just like the open, it's not quite the right trade. They get sucked in, they haven't got all the information. A better trade or a clearer trade is after the Fed day, you see it rally, you see it give it up. That might take a few hours to kind of come through, but then the short opportunity presents itself like, oh, that's an unexpected response trade. I've waited for it to happen. Whereas if you're trading just after the news and trying to catch it and getting caught, it's just that activity that I think can upset traders. So just watch out for that. The other one kind of on the same lines, guys, is the high volatility markets. So it, again, can be seducing to trade something that's moving a lot. But go down a notch. I did a video a while ago about trading the ruble, and you can't actually trade the ruble because of the sanctions, but the volatility was so big there, it's like, whoa. But if you wanted to trade what was going on from the global macro perspective, then trade a couple of tiers down. Trade maybe, equities, or maybe trade silver or something. Maybe that's a bit too direct, but you get the point. The idea is don't go straight there. Trade something that's a little bit more calmer. The volatility is a little bit damper. And so same with stocks. If you're a guy who trades stocks or a trader who trades stocks, then just say, hey, you know what? Maybe I don't want to be trading Tesla on news. Maybe I can trade something a little bit calmer, a little bit quieter. So just something to consider. The final thing is trading after a good run. I think this kills a lot of traders, guys. I am sorry to say it, but I think that, after you've had a good run, very often traders go, hey, I'm going to trade. I want to trade. I'm playing with house money. And often that just doesn't serve you. It just doesn't serve you. So just watch out for that one. I guess really these are kind of market environments, if you like, and the last one was just an extra that I thought I'd add because I see many traders doing very, very, very well and then giving it all back again. You do very, very well, but again, be structured about how much you're going to risk. Say, okay, maybe I've made 10,000, but I'm not going to give back more than 2 before I just take stock of the situation and calm myself down. Other than going, I've got loads of money to play with. The account was much lower than that before. It's house money. It doesn't matter if I lose it, but it does matter because you start to feel the pain of it. So something to consider, guys. Environments in the market where you might be best just sitting out for now. Doesn't mean you're going to be that trader forever, but it might be worth just to get you to where you want to get in that kind of first few legs, first few checkpoints as a trader. You avoid those. Take care. Bye-bye.